Welcome to a special presentation of Barchart's educational webinars. I'm your host, John Rowland, Barchart's Senior Market Strategist, and today we are honored and privileged to have Mark Monroe, venture capitalist and serial technology entrepreneur. Now, Mark will join us and give us his perspective on the technology space in the coming year and from all aspects, from devices to security to generative AI and media. Mark will also give us insights to the world of the venture capitalists and how that has changed in this new higher and interest rate environment. So sit back, relax, as we welcome tonight's special guest, Mark Monroe. Hello, Mark.
Hey. Thank you for having me.
How you
It's Matrix
doing?
season, so I had to go with the black and white.
Mr. Anderson.
How are you, John? Yes, we
I'm
meet
doing
at
very well,
last.
my friend. It's been a long time since we've been together.
I know, but every single time when we get together, it's always magic. So let's make some magic tonight. Let's make some magic.
All right. Well, I want to
Okay.
start you off with a softball here. So, how does one get to become a venture capitalist? Do you go to like a special school or something? This is like the University of VC or something?
Well, I guess let's take the journey back, because some people, they go through finance, they study finance and all that other good stuff, and literally go into probably becoming an associate either at a firm, and then essentially raise up from doing a few deals at a venture capital firm or working in hedge fund, and then work their way up to partner. Some people back in the good old days sold insurance, and then after they made a great deal of amount of money, they moved from insurance into venture capital. So it lets you know that everybody's road into venture capital is different from, and then on top of that, you have your entrepreneurs that did uber successful and they said, okay, hey, I want to invest in the future of tech. Well, that's not quite my journey, so to speak. So let's talk about that real quick, shall we? Okay, so for those of you that don't know, my name is Mark. You can call me Mr. Anderson this evening in the spirit of Matrix theme. But I am a managing partner at From the Culture, which is a startup studio firm where we take kind of like that mindset from venture capital space, but also the startup studio to help entrepreneurs create great ideas that are innovative and very much that will shape the future. So that's what I do out of my day-to-day. But let's talk about how it started. A quick history of my journey. 2004, I was sitting in my dorm room and trying to figure out exactly how am I going to pay for all 4 years of this college called Tuskegee University that I was attending. And August of 2004, sitting in my dorm room, I executed my first trade, which was Apple. Now we'll get into that later because we got to talk about, also what happened in that process. But let's just call it a successful failure for now. And then 2011, I was a startup founder / still trader. And at that time, I was a 3-time founder. And let's just say 2 times the success, or I was successful twice. One of those firms still exists today, though that I just more so sit on the board. But again, still options trader by morning. And this was back in the day where, and John, you could probably recollect that when you see things that happen in pre-market, you see the activity in pre-market, and you kind of understand exactly where the market was going. And it's kind of like, okay, hey, you do what you need to do, you get done, and then you go on about your day.
Right.
And then after 2016, or really after 2015 / 2016, I got into the VC world. So my company got acquired. And then ultimately I said, okay, hey, I want to start investing into startups. Let's just say that it was again, successful failure. Because a part of that is in that same 2018, a few years into VC space, I made the worst trade at the time, losing $18 million on a trade called Apple. I'm sure that John is going to ask a ton more questions about that. But yeah. And then some fun facts about me. I love tech, literally, seriously. I love tech. From companies and startups, from hardware to software. I live my life in it every day. I wake up like it's Christmas almost every day. 98.9% of my portfolio is tech. ish since 2009. If you live your life in an industry, why not show the conviction? And then another fun fact about me, it's illegal for me to drink coffee. Like, one, I don't like it. And then two, it's literally legit illegal. I almost got arrested and recruited into the military in the same day that I tried a venti caramel frappuccino at Starbucks. That day ended in a crash.
You sure it wasn't the coffee? Maybe it was all the sugar in that thing?
I don't know what it was, but I was doing handsprings and people thought I was literally on drugs. They thought I was like on speed or something. And it was just, and I was sweating profusely. I remember that one. And then, I live my life by a simple model. The dream is free, but the hustle is sold separately. I wake up to this every single day. And then finally, I look forward to meeting each and every single one of you. But thank you, John and the team at Barchart, for having me on this platform to be able to talk about the thing that I love, which is the markets along with tech. So that's it. That's pretty much, that's me.
Cool. Well, listen, I don't want to stop you. I think you feel like you're on a roll, a caffeine roll, by the way. So
Absolutely.
let's just dive right into it. So over the
Okay.
last, let's say 2 decades, right? We've had a low interest rate environment, and that venture capitalism has generated an internal rate of return around 15%.
Yep.
And a lot of factors, margin expansion, revenue growth, all those kinds of things. Do you think that in this new interest rate environment that this is going to be a major headwind for the venture capitalists or even the smaller startups? And how are you making adjustments to this new interest rate environment?
So it's very interesting. So let's roll the clock back a little bit, where you're talking about when we were in a lower interest rate environment. During that environment, money was just flowing through the venture capital space. So you were seeing startups that were getting funded with, pretty much like, I wouldn't say napkin, just like the .com bubble. They were able to show a little bit of market validation, but yet at the same token, their valuations were significantly stretched. So like if I'm doing a seed round, you see companies that are raising money at seed round at like, let's say $26 million pre-revenue with nothing, no customer bases and everything else. Now let's fast forward to where we are now. Venture capitalists, especially as we started to look at what took place during the SVB situation earlier this year, it really caused a lot of VC funds to really like take a hard look at some of the companies that sat within their portfolio. Exactly where are they going to end up? There were companies that were literally strapped for cash, and that was something that you saw people like when you were looking at those videos on CNBC and everything else talking about like people doing bank runs and everything else. We were getting calls on our end about like companies that were looking to stay afloat, just trying to make their payroll. And you also saw companies that were also in the midst of fundraisers that ultimately those fundraisers got cut. And so in that typical environment, especially like if you were having to like throw capital at startups, like at what valuation? And at this point, we're at the highs of the market in the startup space. So what we saw in like just like we saw in 2022, where a lot of publicly traded companies had their valuations like pretty much corrected to a certain extent. We saw the same thing take place within the venture capital space. So like look at like companies like Stripe that was once upon a time valued at $90 billion, took a $50 billion haircut, now worth $40 billion in order to raise capital. So that's what you saw this year, where you saw a lot of companies having to have their valuations reevaluated in order to raise capital. Because now at this point in time, especially if the cost of capital is high, am I willing to pay that high price of a premium anymore? Now let's look at as it pertains to this next frontier of environments. We're seeing a lot of venture capital firms that are doing new fundraisers, that are getting ready to essentially deploy new capital starting in January. And it was kind of like a freeze of funding. We didn't see as much funding as we did in years prior. I think that that's going to change, where we're going to probably start seeing more companies or more funds taking on that risk going into 2024, making more investments, but more refined, much more focused as it pertains to balance sheets, or say, for example, milestones being a little bit more realistic. So it's just more so in the sense that we're just seeing everybody just like, okay, let's get it a little bit more tight and a little bit more lean just to see exactly what is it that you can produce. But overall, I think that the winners will, just like in the publicly traded markets, the winners will still be winners and the losers will still be losers. And ultimately, those losers will ultimately either be chop shopped and ultimately sold off, or essentially acquired at maybe anywhere from 5x to 10x.
So in your selection process, what I'm kind of hearing is that you're gonna hold these startup companies at a higher bar now. And so then my question,
The
follow-up
bar's been
question,
raised.
right? So my follow-up is, how do these small companies get a foothold if they don't have that influx of capital? They might have a great idea, but if they don't have the
Yeah.
capital to create something or to show you something, and you're holding this bar above their head, then to me it sounds like really the wave or the next wave of technology is got to come from those who have capital, and that sounds to me like the mega
Not
caps.
exactly. Not exactly. So, and yes, you will start seeing more mega caps like stepping into the early stage investment space. I strongly agree with that. You will see that. You're already starting to see parts of that where they're taking parts in Series A and some Series B, and I think that they're going to take a little bit more risk appetite towards those seed round companies, those early stage. But we also have to take into consideration, given that we've seen this democratization of technology over this period of time, let's say over the last 5 to roughly 9 years, technology itself has gotten so much cheaper. It's gotten so much cheaper to be able to produce something. You can literally go to some of these platforms, like for example, a Locify with like designs that you've done for an app idea, and then literally take that design and it automatically uses AI to generate all the front facing code. All you have to do is just write the back end. So have some type of engineer that writes the back end and ties the front end together, and now you have an idea that saves you 90% of the cost that it would have taken to literally create such an idea. So a lot of the tools that we're seeing out there, they exist. I think the thing is just that market validation. So outside of just us looking for MOU, we want to see exactly like, okay, hey, well, how is it actually performing? Is it actually making a significant difference in your customers as it pertains to them using this tool versus essentially can they still do without it? Also, at the same time, it's like, nobody really gets funded with just an idea unless you're a two-time founder, or if this is not your first rodeo. If this is your first rodeo and you haven't seen like either an exit or something like that before, then yeah, you're going to be a lot more highly scrutinized. And so then at that point, you just have to prove it. The ones that have been proven within the marketplace before, they're okay with being able to essentially get that next set of funding, because you look at this and say, okay, hey, well, there's a higher chance of them being successful because they've been through this show before.
So where are you looking for opportunities, or what's parts of the technology space do you think that there's going to be some greater opportunities?
So the greater opportunities as it stands right now is all things looking at an AI focus. So in this year, you saw a lot of that generative AI. So like, for example, things that were closely tied to ChatGPT and that's where I'm starting to notice like there's a certain set of trends where we'll see generative AI still continue. And then of course, we'll see other areas of AI, like for example, machine learning, that ultimately refine a process or that even reinvent a process. So like there's a lot of disruption. The places where I'm looking at is I think the consumer market has already been significantly disrupted, but the business to business market, it still has a lot of refinement. It's like the way that you can look at that, and it brings me back to publicly traded companies. How many publicly traded companies out there still have not embedded AI into their overall workflows? And those are going to be the companies that are probably going to be doing a significant amount of spend going into next year or starting next year, and trying to bring their companies into the next century or into the next generation using those AI tools. So looking at areas of even, like look at the entertainment space. Like if we look at like, for example, the actor strike and the writer strike, what were they very much so afraid of outside of the normal union topics? The number one topic that was consistently discussed was AI tools. And so, especially Gen AI. So we're looking at those arenas and saying, okay, hey, how is it that we can do things better? And at the same token, how is it that we can bring more value to the space? And at the same token, raise valuations of the existing space. So let's take your standard. Let's take something as far as, let's say, a grocery store, right? How can a grocery store use Gen AI to essentially bring forth more revenue, but not have to but also at the same token decrease their spend? Well, how do they do that? Is you can use Gen AI to literally recreate a lot of the imagery and everything else, and then literally put it within places and mediums of social media. And then from there, it's like, okay, hey, well, now you're using that as your general advertisement, less than what you're spending in, say, for example, putting your ads in newspapers and everything else on a weekly basis as it pertains to coupon systems. So that something like that, as simple as that, makes it easily available for disruption. And something that, look, I probably just gave that idea out to somebody for free. But I mean, you get my point. There's areas in which that I have a firm model of saying, whatever that makes everybody else lazy, if you can make everybody else lazy within a space, then 9 times out of 10, somebody's going to invest in it. That's a big idea.
So let's draw on that. So you're saying that generative AI is definitely the space that you're looking at. You're looking at for that better mousetrap and how it can make lower costs and increase productivity. I mean, that kind of sounds like to me is the outsourcing in the manufacturer sector that happened, let's say, in the 80s and 90s. So are you concerned that AI is going to replace, let's say, the human element, and that there could be this dynamic shift in our economy where, everything's more productive and it's a lot easier to be lazy, but hey, I don't have a job because, this computer basically put me out of business, right?
I look at it in the sense of I look at it in the same way that we looked at when we first saw email. So remember when we first saw email, we thought that, oh, well, people are going to send each other electronic mail. And then it really started to take shape where everybody was sending each other emails and everything else. And then, I think Hallmark jumped into it, and then that you were able to send digital Hallmark cards. And then people were like, well, that's just going to take the postal service out of business. Well, or out of rotation. Did it? No. I mean, if anything, they're still alive and kicking, though I wouldn't say the postal service, but more like FedEx and UPS. But
is that email, or is that the sale of goods, right? I mean, post office lost money for many years, right? I mean,
they've been. I think that even before email, they were losing money. Yeah. I think that was the thing. But I think that the thing is, it knocks out the repetitive tasks of things. So AI will definitely remove the repetitive tasks of a lot of things. But then at the same token, it's going to open up new opportunities that will provide space for folks, even within existing industries, to be able to be trained a lot easier, because it's the differentiation from, I'll say it like this, for example, the people who do QA, QC, quality assurance control testing, and let's say car auto safety and everything else, those same individuals that work at the factories will be using AI. It's not going to take away their jobs. If anything, it's going to create more jobs for them, because now they're going to be looking at things outside of just for example, just the car, but looking at the entire environment. And that's a lot of data that you're going to have to take in. That's a lot of modeling and everything else. That's a lot of training that AI is going to need to be able to involve. And then on top of that, you're going to have to build a city alongside with that can support that technology. So if anything, I think that it's going to create more jobs in specific spaces. But at the same token, we do agree that essentially that it's going to, yes, it's going to knock out some of the jobs in which that start to become archaic or more repetitive, and then essentially build upon new things in which that people can be more creative and also create things for a new city, new future, whatever it may be.
Interesting. So you say AI is going to be this gateway to this new utopia, I guess I could say. But
I wouldn't say utopia.
So, are you looking for investment opportunities in those that are implementing or creating the AI? In other words, are you looking for those who are going to win the wars, these wars on the battlefields of innovation, or are you looking at, I really just sell, I know there's a war going to go on, but I'd rather just sell the guns and bullets, right? Like
Well, yeah, that's
semiconductors.
normally what startups do. That's normally what startups do. Like think about it like this. And you and I have been able to see it over the periods of time, over like a span of decades, right? Where we've seen the inflow, the amounts of companies that went IPO back in the day, versus the amount of companies that are now going IPO. Now, of course, we had this big old SPAC boom and everything else, but yet at the same token, I think that honestly, it's like it's going to create more and more opportunity for those companies to become acquired. Now, the question is like, okay, hey, who's going to be those companies that are acquiring these companies? Because most companies is like when you normally ask them, okay, hey, well, what's your exit plan? What's your exit strategy? Nobody even like really even talks about that anymore. It's kind of like this unwritten rule that 9 times out of 10, if you build it big enough, there's going to be certain companies that like, if we're talking about just winning some small battles, those are going to be the companies that get acquired. If you're talking about companies that win an entire war, those are the companies that are like your unicorns, like the next generation unicorns that will literally redefine an entire industry. That they'll play alongside. They could play alongside with all of the titans, and regulation will slightly bar some of those companies from even being able to acquire them because of antitrust monopolistic practices, which gives them the opportunity for them to go public and also join them inside the ranks at a higher valuation. So I think that that's the way that we got to look at it. The ones that win the small battles, those are the companies that ultimately get the 20 times EBITDA, the 30 times EBITDA acquisitions, versus the companies that are the unicorns that redefine the industry. They become, well, we don't know if they'll become a titan or not. That's for the future to tell us, but they'll be able to have that opportunity to go to that next level in that space to go public.
So you have a very trained eye. I don't see many unicorns running around my neighborhood. I don't want to put you on the spot. Do you see unicorns on the horizon, or are you looking
I
at?
do.
Will you be willing to share some of those with us?
Sure. So I look at it like this. Remember what I said, the things that make people lazy, the things in which that literally, those are the things that are like the small battles, the things that redefine an entire industry, that make people say, oh my, like it scares people enough, but at the same token, it's scary good. So like, for example, I could see a company like Forward going public. They're a company that's concierge medicine, that where you just pay, like I think subscription medical will be the new thing outside of just going through healthcare, your standard healthcare and insurance companies, which with them, it's like, okay, hey, you just pay a membership fee, or you just pay all your fees up front annually. I think it's like 15 to sometimes in some cases $2,500. I think their next wave is to also start doing family plans. And I think the moment that they do that, it's pretty much anytime that you need to speak to a doctor, you got the telehealth. You can also have folks that are coming to you to like do blood draws. You can actually have your data in the same day as it pertains to the results. So you have those types of companies. Of course, we see Stripe on the horizon. I think that another company, Epic Games, the same company that makes Fortnite, the same company that makes Unreal Engine, that's literally redefining the film and TV space, they're going to probably go public sooner or later, because right now we only have their competitor, which is Unity, ticker U. If you want to take a look at them on our screen, they are the folks in whom which that are their massive competitor that can literally, like, I think the day that Epic Games goes public, that's the day that, say, for example, Unity is in trouble. Like mostly, like if you notice, most of your car commercials and a lot of those like things, like you can probably see it in your car commercials more so often. A lot of those are not really the car being driven. That's actually been done through Unreal Engine.
Interesting.
Yeah.
And then
So
below that, what smaller companies do you see that could be acquisition type candidates?
Outside of all of them,
Not all of them, obviously.
yeah. So like, I look at it like this: any company can be acquired, like in this particular space, for a numerous set of reasons. Either the founders are just like, okay, hey, this is probably the best yet that we're going to ever get to, or say, for example, the economics are also changing, which makes it more expensive for them to stay in existence, and you're kind of strapped for cash as it pertains to cost of capital, and you're caught in that rough patch of space. So that you're probably, you're going to see companies that are going to be faced with acquisitions. probably more so often based in 2024, because they were able to weather through 2023, but many of these companies are limping into 2024. So either they're going to need to have a significant inflow of cash and capital, or essentially they're going to probably be acquired by some of the major players. I guess the best example to look at is you're seeing, I think it's Adobe. They're struggling to acquire a company called Figma. Now, what we know about Adobe is that they've been very heavily into things that are creative productivity applications. Well, Figma is a major player within, like, if you look at all apps, every single app that you have on your phone was designed by somebody. And 9 times out of 10, most of your apps are designed using that application called Figma. Well, Adobe has been trying to acquire Figma for, I think it's $20 billion. Like, let that sink in. $20 billion for, I mean, remember, like, it goes to show you where we're at. Like, Instagram was acquired for like just shy of $1 billion by Facebook, now Meta. And then essentially WhatsApp was also acquired for, I think it was like maybe $1 to $2 billion or something like that. Now we got companies being acquired for 20 billion. So yeah, we're definitely seeing some opportunity truly within this space as it pertains to places of, acquisition for sure.
So what other spaces in the technology are you looking for opportunities besides generative AI?
I mean,
healthcare you mentioned was one.
Healthcare.
What about security and devices?
Security is always going to be like the consistently under acquisition targets. I mean, most of these security companies, they know that they're going to solve a problem, and 9 times out of 10, they're going to be acquired by one of the top cybersecurity firms out there, because they know that essentially, like most startups now, is that, okay, hey, we can try to compete with these companies, even though that what we bring is so massively disruptive. But there are so many of those companies out there in which that it's not as monopolistic as, say, for example, a Microsoft or an Amazon or an Apple acquiring them to can literally control the entire space. I think that within these cybersecurity functions is that they see holes, and somebody was able to solve that problem that cybersecurity firm wasn't able to solve. And essentially, instead of us going out and hiring a massive amount of team just to literally rebuild that entire portion, it's actually cheaper for us to acquire it, because now we have the talent that can support it. And then on top of that, we also have the technology that they can also work towards integrating it over the next 6 months to a year. So I think that those are the things that we look at it as it pertains to cybersecurity. We look at it as it pertains to consumer retail. We look at it as it pertains to even places like industrial companies. You'll probably see that too, where industrial companies are probably going to start acquiring more tech-based companies that have strong use cases that support their business for them to acquire it. I think that that's definitely going to be the play moving forward from 2024 and beyond, which we've already seen play out, but I think that that's going to be even heavier. So
you're talking big boys game, right? Big money, big boys game. You said $20 billion, that might be walking around money for you, but how does the retail trader get involved? Let's take the Magnificent Seven for a second.
okay.
These are all great companies, but Meta's $300, Nvidia is $500, AMD is $130, Microsoft is a $370 stock. I mean, that's an expensive stock. I'm just a regular Joe. How do I take advantage of this new wave? And do I just buy the big because the big are going to get bigger? Or do I try to look for some ways to maybe diversify my portfolio?
Yeah, the first place where you would probably start is look to diversify, of course. I mean, if that was anybody in that space, and if stocks are too high, then of course I'm going to look at okay, hey, there's strong ETFs out there where I can own the entire sector, I can own that entire industry without having to pay such a large premium as it pertains to just owning that one specific stock. I mean, you could blow your entire bag of capital just on buying, a few of those stocks versus essentially owning the entire industry. And on top of that, in owning some of those ETFs, you kind of slightly decrease some of the volatility within your portfolio because of the fact that it's not just one stock. So if that
The
stock
single
is having a
stock
bad
risk.
day,
Yeah.
you've got a headache versus owning the ETF, and it's like, a bee sting.
So do you look at the large ETFs, or do you look at some of these specialized? Like I know there's one that I'm looking at a list here.
Should we share
AIQ,
your
which is
screen?
the GX artificial intelligence. I don't know who their constituents are inside of that portfolio, but I mean, that sounds kind of like where we want to be, right?
Yeah, so if you're in like if most of your AI portfolios are going to consist of having like semiconductors, it's also going to have like some of the other companies like Adobe, your CRMs, your C3 AI companies that are doing stuff within the AI space, like owning Google, and many others in that space. So yeah, you can own like those that are very specific, and essentially, like I said, have that diversification. You guys hear me talk about this a lot of times where I say, a rising tide lifts all boats. And so, given in the sense that, kind of like Nvidia and Microsoft were like the front runners of like this AI boom, I suspect that like now, like, okay, it's kind of like it started off in this small text message group between one or two people, like Adobe, Microsoft, and Nvidia. They started off in this group chat together. And then next thing you know, like somebody says, well, we should invite some of our friends. Now AMD has entered the chat as of this week with releasing their AI chip, which now is which is even cheaper, which also gives like the market a little bit of choice. And I think that when the market has choice, and essentially it brings forth competition, and competition makes it better for consumers because now they have better options. And so when we don't have that, then markets get stagnant, and then ultimately, the entire sector or the industry starts to flail. Exactly why we see Intel underperforming the rest of the semiconductor space is because of the fact that for a long period of time they were so dominant, and now at the same token things got stagnant, and then the competition retooled, re-geared, and now it's like they came back and took Intel's lunch. So I think that that's the way that we look at it. There's going to be more players that enter into the conversation, that maybe didn't rise by 200 and something percent this year. But at the same token, very good companies, valuations are cheaper. They have a strong balance sheet. They also show that there is great deal of promise, and which leads to the other part. The other part of the conversation is use case. Like, is there a strong enough use case for people to want to essentially own those names? And I think that that's what it's going to come. I think that that's where the theme for 2024, in my opinion, is literally about use case. Is the use case strong enough for us to want to be able to say that we are owner of this company or of this stock?
So are you? I'm trying to read between the lines here. Are you saying that those that have led the way in this 23, maybe they've gotten to a forefront, but it sounds like you're kind of saying is those that were kind of left behind and maybe might start to catch up or maybe even leapfrog them. Is that what I'm hearing?
I wouldn't say leapfrog them yet. I'm not like that would be like the hot take. But you never know. Like some of them, you never know what some of these companies have cooking underneath the hood. But I think that that's going to be very hard to leapfrog like your Nvidias of the world because of what they've done within the space and what is it that they continue to keep doing. I think that once they like that Jensen's like, okay, hey, we stumbled across lightning in a bottle. I don't think that he's going to give those grips up anytime soon.
Mm-hmm.
I think that it's going to create space for like the AMDs of the world because not everybody's going to have Nvidia type money to be able to buy such products. And so they're going to look towards other alternatives and look no further. You got companies like AMD, and that's going to give AMD enough emphasis to stay relevant in the conversation and what they do moving forward. I don't know if they're going to still leapfrog, but it allows them to get a little bit comfortable within the space. I think that what we're seeing. Go ahead.
I was going to say, you mentioned Intel. Do you look at them in that because they're kind of retooling, right? They're coming out with a new AI chip, right?
So they're coming out with a new AI chip, and then on top of that, they're also like the thing that Intel has always had, but they never use as quite the advantage until I guess now, is the fact that they have their own foundry system, which means that they have their own process where they can create their own chips. Whereas AMD and Nvidia work very heavily with like companies like ARM and let's say TSM and SMIC
Right.
and Samsung. So, Intel doesn't have to do all that. They can do that all on their own. And given in the sense that, of course, people are still nervous about what's happening over there in Taiwan, between China and Taiwan, it's amazing to me how Intel hasn't entered the chat and saying, hey, we can become your company for Foundry as another alternative option. I think that that's something that they should definitely explore. And I think if they do, I think that can be a great space for Intel. Like, whereas like they don't have to be the person that ultimately is the mine like the other companies. They just have to be the people that sell the shovels.
I mean, I'm looking at a chart of it right now. I mean, it looks like, it's been in a nice uptrend. But you're talking about a difference between a $42 stock and a $400 stock when you talk difference between Intel and Nvidia. So I mean, so that question I would ask you is if you had to put $10,000, and again, I'm putting you on the spot here. I mean, would you rather put it in Nvidia or would you put it in Intel as a venture capitalist? That risk to reward ratio is
so like for me. Given where I'm seeing Nvidia currently trading at, I would probably step more so like in the sense of maybe I would still be 60% Nvidia, but also at the same token being 40% if I had to choose with those. I would probably go 40%, or I would maybe go 50% in Nvidia and then 40% in Intel because of the fact that it's cheaper. I look at Nvidia that the fact that it sits at the top, but then at the same token, we still like the thing that like kind of like holds me hostage here with Nvidia is when we talk about like, okay, hey, the stock, the thing that holds me hostage is that, okay, I ask, like, if I'm looking at this chart, is this the best that I'm going to see from Nvidia, or do I still expect more from Nvidia?
Right.
Like, that's the question. Like, and me being in venture capital and understanding like, for us, it's all about growth. Look, I mean, just like if we're saying in the EV space, it's Tesla's world and everybody else is paying rent. Well, I mean, in this particular space, it's Nvidia's world and everybody else is paying rent. And the thing is, Nvidia is making it easier for also other players to step into the space and use not only their hardware, but also their software models to recreate and redefine AI, which also benefits them significantly. So for Intel, I'm saying 40% because of the fact that I do see that, again, if Nvidia is rising and if Intel is just staying in the conversation, then that's good for an Intel because it's a rising tide that lifts all boats. And if anything, it gives me a little bit of diversification. Though, personally, I would probably choose AMD.
AMD. You like AMD. Okay.
I
didn't want to put you on the spot.
I'm a huge fan of look, I'm a huge Lisa Su fan, like honestly, and what she's done to turn around the company. I know that they just had a significant breakout
they had
over
a
a period of time.
Today, yeah.
And that's just because of the fact that, again, we're seeing that, there's a lot of appetite for what is it that they can provide to the marketplace as it pertains to, hey, we have these chips that are now available. So we know that NVIDIA stays on back order. Well, this gives you another option as it pertains to like AI chips that you can buy. So again, it's like, I look at that and I say, okay, hey, now they've entered the space. And on top of that, the other part that makes me very excited as it pertains to growth is that Xilinx acquisition is actually starting to play into the conversation when we start to think about autos and autos getting smarter. So, I think that they can also use that technology in like stadiums. They can use that technology in other spaces also, which is a major up for AMD versus, again, an Intel. But if I had to choose, like I said, it's still NVIDIA's world.
Let's change the mix here. Do you go 50 NVIDIA and 40
so now if I have all three?
Yeah.
If I have all three? Oh, okay. So in this conversation, then I would definitely go probably 40% NVIDIA. I would probably go 20% AMD, and I'd probably go 15% Intel. And then essentially, if I'm getting any type of downside, then I'm just adding to the position.
Right.
If I have the opportunity to do so. To build
always got to keep a little cash in the pocket, right?
Always, you got to always keep a little bit of Carter fire on the side just in case the fire will away.
But let's talk about valuations in terms of all these publicly traded companies. I mean, what I see in a lot of these charts, they're all looking a lot the same. I don't think there's a rush for us to get into the market right now. And, and we're talking long-term investment, right? So are you
Yep.
looking for buying opportunities on dips, or are you waiting for the markets to break out of the, a lot of these are, just hovering around, their 52-week highs or their all-time highs. Nvidia is definitely one of those ones that we could make that case. But, maybe the
Yeah.
only one that it looks like it's breaking out is Microsoft, which I think
Yeah.
is definitely a company. If I'm hearing what you're saying this sounds like a company is gonna, if they can't make it, they're gonna buy it, right?
Right. Like, and then on top of that, now that you are that, like, you have to take into consideration, Microsoft owns 49% of OpenAI.
Right.
I
So
mean, that's
right. So
that's a
this is,
major opportunity.
yeah. I mean, it just seems like a no-brainer. I mean, they have a history of acquisition, right? That's how they
Yeah.
advance, right? I mean, that's their whole, I think that's kind of their business model. But, on a technical standpoint, you've got this little cup and handle, and we
Yep.
have broken out of this all-time high. So I just want to let you folks know that, one of the ways that I look at one breaking out of the highs, I want to see that stock break out on a multiple of, let's say, a 20-day average 2 range. And so for Microsoft, it's $6.60. So
Hmm.
we have to get above, let's say, $10 to $13 from where we're breaking out to give me that confirmation. And this is what I'm kind of asking you, Mark, is, this is a weekly chart, but let's go to a smaller time frame. We
Okay.
kind of got that breakout, but we didn't get the follow through. And now we're back, where we broke out, which is, technically a good sign, but we never really closed above, let's
Yeah.
say, that 1 to 2x. So my question again
Yeah.
is, do you think during the year 2024 will we have some better buying opportunities in a lot of these
I
tech
believe
type
so.
stocks?
I
So
believe so. Absolutely. We will
patience
definitely
is a
have buying
virtue.
opportunities. Yeah, patience is a virtue, patience pays, and ultimately it's like, I always tell people FOMO is not a strategy at all.
Right.
So I mean, in this particular arena, and especially if you're looking at like looking to own these names over a long-term period, it's kind of interesting to me where it's like I hear long-term investors that are looking to buy and hold stock and sit on it for X amount of time, but yet they're walking into it like with a trader's mindset of saying, okay, hey, I have to do this on a day-to-day basis. When in reality, you're not a trader. If you're an investor holding something for the long term, you got to think about it as it pertains to where you pick your spots, of where the price seems attractive, and essentially be a buyer at that point in time. Like for me, for a company like this, I would have no problem with Microsoft, of course, even if it goes to higher highs. But I would be waiting for I would be sitting there waiting patiently for the next time that the stock probably corrects, because we hold some of these truths to be evident that all
Right.
stocks must be corrected. All stocks will be corrected at some point in time. So honestly, that's the way I look at it if I'm a long-term investor in this marketplace. But yeah, I think that honestly that there's a lot of great potential for Microsoft to the upside. But I think in the short term, over the next, let's say 3 to 6 months, I can definitely see the stock coming down.
What do you think about this company?
Okay.
Not Mozambique. I just want to get your take on Amazon,
Oh, Amazon. Ooh.
because I mean, if you think about this, I mean, talk about a company that's um, gonna transition, right? I mean, from basically a bookstore, right, to now,
Yep.
which what we're thinking about, right? I mean, with their AWS, right? I mean,
And now they have and now they're building an AI chip too.
their own chip, right?
Hmm.
Who's gonna, are they gonna make it? Who's gonna make it for them?
Well, I think that again, it comes down to who this. Like I said, remember that rising tide lifts all boats.
Right.
Like if Intel steps into the space of being the foundry for some of these like major corporations, like for example your Amazons and your Googles, that produces a major opportunity for Intel. So like for example, and then this is good for Amazon because of course now that you own your own chips, I'm sure that there'll be a mixture between both Nvidia and Amazon based chips. I mean, I think that
Hmm.
that's what it's going to look like most companies. But again, I look at that as a strong upside opportunity in the sense of it makes their cost to do business cheaper. And then essentially it makes like the biggest thing that makes me look at it from an investor standpoint is I'm looking at it in the sense that, well, how good, once this gets to a place of scale, how good will their profit margins start to look?
Right.
Like
Well,
that's
I
that's where
understand they're
that's where the name
getting
of the game.
they're getting in healthcare. I mean, you mentioned that one
Yep.
healthcare company. I mean, that sounds like right in their wheelhouse. Hey, this is how they get into that space, right?
Indeed. So again, it's like there's a lot of upside opportunity. Like, you look at your CVSs and your Walgreens and everything else, and of course, those are all brick and mortar. That, but we look at it as in the sense of brick and mortar. But then at the same token, we look at their market caps. Okay, if let's say that CVS was at, what was it, like, let's say, I don't know for specifics, but let's just say CVS was at like a $20 billion market cap, and then CVS is gone tomorrow, and then let's say Amazon steps into that space. Well, given Amazon and what they're at, and then also maybe not being brick and mortar, but maybe a hybrid of that. Well, does that market cap stay at 20 billion, or are we looking at something better with better profit margins that are associated to it?
Well, I mean,
that's the question that we have to ask.
Yeah, I think when we think about somebody like Amazon, they have a track record of making things better, right? So
I will say though that Amazon is probably one of my picks for 2024, especially in an event where I think that if we find ourselves in an event where Amazon, well, not even just Amazon, let's just say the economics, right? If the economics support like the industry and the business. So let's say that if we expect that the Fed in the second half of the year starts to cut rates, well, is that good for consumer discretionary or is that bad for consumer discretionary? Well, I mean, I would probably say in some cases it's good for consumer discretionary. Other areas maybe not so good. Like, for example, and I saw the comment in that's I pulled up on the bubble, a Tesla in a rate cut environment, that's good for Tesla.
right.
And an environment for like Amazon, then that would probably spur more people to go out and spend. And essentially, where are they going to spend? They're going to spend those investment dollars into, let's say, using more AWS and everything else. That's good for a company that's good for Amazon. I think that what we saw was a lot of companies had cut their spend earlier this year. And I think that now that they got their balance sheets and their let's say their expenses under control, I think that now they're going to be placed in a position where they're going to have a little bit more firepower to spend next year. And I think that Amazon is definitely going to be one of those spaces.
So this is kind of what I was pointing out. Why I think that there's going to be better opportunities. First of all, you can see these green boxes, which represent areas of distribution, right? Where market evaluates and then it accelerates and impulse, and then market comes to consolidation. So for me as a trader or a long-term investor, yeah, I believe the market is going to go higher. But I can wait here. I would rather buy this stock at $185 than at current at $140. And I know that sounds crazy, but you can see in the past, once it gets back through these areas of distribution, that's when it starts to move again, right?
Blast off. Yeah.
Right. So again, I think there's patience is going to be our virtue for next year. Definitely moving forward. All right,
I still expect those Magnificent Seven companies to still be magnificent. I just don't think that they'll be just as magnificent as they were.
Right. I mean, this year, 100% return. So I think we have to be more realistic about the types of
whether our expectations.
Yeah, exactly. So let's go back. I'm going to do just we have a little bit time left here.
Okay.
So let's see, where are we? Apple. Where's my Apple man? Here we go. All right. I want to hear this story, and then I'm going to tell you my Apple story because I think this is intriguing.
Well, which one do you want to hear? Which one do you want to hear?
I want to hear
how it started.
First of all, how do you put yourself in a position where you lose $18 million? But that the old expression is, how to make $1 million trading options. You got to start with $5 million, right?
You got to start with 5 million.
Right. So, how do you put yourself in that position, and what lessons did you learn from that? Oh, what the F did I just do moment?
I think my biggest thing through my period of time is always like, it's always been the lesson learned over periods of time is never let your cockiness supersede your talent. And so that's always been my go-to. Like, when I first started trading Apple in 2004, did very, very well on that trade. But then I got so cocky, I was like, I can leave it and it'll be all right. And then next thing you know, the stock like literally just, it turned the opposite way for a young college freshman. That was literally in the same month of when school had just started for me, and literally just went the opposite. So if we look at it in the month of August of 2004, you'll see probably that dip that we took right there. Yep. No, yeah. Let me see. Oh, he's literally pinpointing the.
I want to know.
John is
right here,
ruthless. Okay.
It peaked out. I mean, it's changed scale, right? But
yeah, so that's June. It
was at 61 cents. So I mean, that's because
and then boom,
yeah, it fell by it fell by about 20% in about 6 weeks.
6 weeks. So again, it's like, I came back the next week, and I should have sold that the week prior and didn't do it, and came back the next week, after I'm finally catching my bearings in school, and next thing you know, I come back and I'm like, was up $3,500, now down to like pretty much like next to nil. That was trash. And then, of course, we have the glorious 2018 where the Fed's taper tantrum that was ultimately transpiring. And literally, okay. Yeah,
is this the $18 million trade?
Yep, that's it.
Right there.
That's it. And pretty much I came back. And so what I was doing during that time, though, I was actually taking part in an investment deal that was literally for a drone company that was focused on like the fail-safe technology for a drone. So when drones fall out of the sky, they fall at a very fast pace, about 20 miles per hour. That can actually hurt somebody, possibly even kill somebody. And so they wanted to create something that when the system recognized that the drone had failed, it would literally deploy a parachute system that would entangle and everything else. So that way you could recover your drone. And essentially, it would also send feedback to the drone operator for them to be able to go back and retrieve their drone. And the beautiful thing about it is you went from 15 to 20 miles per hour to then like 1 to 2 miles per hour. So even if it fell at 1 to 2 miles per hour on somebody, it's like, okay, yeah, it may ding, but it's not going to hurt you.
Right. It's not going to kill you.
And so that was huge for me. And later on, now that deal is probably going to solidify next year, where that company gets acquired by, I think it's either Boeing, Walmart, or Amazon. They're filtering out deals for those companies. And so essentially it's like, okay, yeah, it sucked, because like you come back and you're like, wow, everything's on fire. And you like, it was originally, and I was telling you this before we went live, I said, I came back and I was like, I'm down by 18,000. And I realized I had to expand. I had to expand the browser because the losses didn't even fit. Because I was like, wait a minute, 18,000. I was like,
who added these other 4 zeros, right?
I was like, is there a misprint? I may need to call my brokerage and find out what's going on. And then they said, nope, if you expand it, then you see it all. And so
let's be honest with ourselves here. Was it because you overtraded, and you stepped outside of your trade plan, or is it
was more so in the sense that I wasn't even paying attention to my position? Like, honestly, I stopped paying attention to the trade because I was just like, okay, we'll be fine.
Right. Tomorrow's another day.
Tomorrow's another day, or say, for example, it's Apple. Apple will be just fine, whereas everybody else can like literally be floundering, and Apple is just like, hey, I'm good. What I thought was safe, without me having any type of watching against what I would normally do as a trader. No stop losses, no nothing. It was just like, okay, well, here we are.
So
lesson learned.
What was the lesson? Yeah. So the lesson was learned with stops, have stops, have a plan.
Well, of course. I mean, I always knew about stops. It was just more so in the sense of make sure that, though that if I have a bunch of things that are going on in the background that doesn't allow me to like at least check in the market, then one, I shouldn't be trading. I shouldn't be trading at this point in time.
Right.
I shouldn't even have a trade that's active if I can't even, like, especially as a trader, you shouldn't have anything that's left open if you can't focus or if you can't come back in and check on it. Like, I didn't check on it for months. I didn't even look at the brokerage account for months.
Okay, now now it makes sense. Right. So if you're like being hypnotized by something over here and you got all this stuff over here, maybe it's better to close this stuff out until you can.
It was better to just close out the position and literally just like retool. And then next thing you know, the very next year, we had this amazing bull run in 2019. So,
all right. Yeah, so
that was pretty much it.
You want to take a couple questions before we get out of here?
Yeah, let's do it.
All right. Can you see the questions? I see a lot of them are in.
Okay, so somebody said big fan of Tesla. Shout outs to and
yeah, Refined Warrior is one of our regular
AI space. Nice. What role will it play in the AI space over the next 5 years? Oh, it'll be huge. I mean, honestly, like, from what we're seeing in the FSD tech, and literally they're kind of doing the same way that how NVIDIA did it, where NVIDIA learned from the cryptocurrency space. And since they were late to the party there, but they use that technology to essentially like say, okay, hey, let's do something else and create. Like Jensen Huang's used his a failure in one specific business arena to create a success in a completely different arena. Now, I'm not saying that that's going to be Tesla to use a failure. I think that honestly, they're going to learn from their successes, and the thing that they've learned so well is we're successful now, but we don't expect that this same exact success will ultimately propel us in the future. So they took the full self-driving chip technology, and now they're getting into places like robotics. I think that they'll also play a role into like warehouse logistics, as well as the next generation of what we know of as it pertains to modern manufacturing. So I think that honestly, like if you look at their robot is like if the Tesla FSD car is literally 2 chips, the robot is like I think it's 36 or 40 chips in one robot. Like that's huge. Now the thing is, I think that honestly, if they can get their process down, which I strongly believe they will, in supply chain logistics as well as manufacturing of those robots, that's a huge upside potential, especially if their cost for making the chips is low. I think that that's going to be a huge opportunity. And I think that the next part is, and we're already starting to see it with like the supercharging network where you're seeing other car manufacturers utilizing that tech. I think the next wave of that is where you'll start to see them license out that FSD tech and FSD technology and chip technology to other manufacturers that just realize we can't keep up, but yet we want to be in that space. So I think that that's the next. I think that's truly the next wave. So as whoever though controls public transportation though is the winner.
So as an investor, do you think that Tesla's a car company or a tech company? Sounds like you think it's a tech company. But let me.
I definitely believe that it's a tech company. It's definitely a tech company. I strongly believe that it's a tech company, though that at the same token it's really showing car characteristics, car company characteristics right now. But when you see what's happening underneath the quote unquote hood, then you definitely see that it's definitely a tech company. Like when you see that their margins are better than everybody else and that they can also refine things and also have pricing power where they can like literally maneuver price just in the car space, I'm really excited for what they're going to do in robotics. Like, because people thought once upon a time it was Boston Dynamics and Hyundai that were ultimately going to lead the space in robotics. And yet we still haven't seen what their stuff is still not on the massive market. Right. I think that honestly Tesla has a strong shot now, and I think that we'll probably see that in 2025.
As a long-term investor, would you like to see Tesla split off the car and just become a tech company, or do you think that there's still value in?
Like I think there's still value there. I think that there's still value there because it's kind of like this continuous feedback loop where they use the existing business models that they're using to refine it into other spaces of their business offerings. So we saw that happen within their car manufacturing, and then they brought it into the energy space. And we've seen what they've done in the energy space, and now we're seeing what they did with like FSD tech development. We saw what they did in FSD tech development, and now we're seeing that they're doing that in their robotics division. I mean, come on, they're literally creating new metals, like new elements in their shop. So honestly, it's like that's something that's going to be very, very interesting to see exactly, like I said, over the next 2 to 3 years. I'm very excited for what is it that's going to come out. And my projection is 2025, where we probably start to see that, where we probably see maybe the first one like literally in the wild.
How about this question? I like this one. What are your thoughts on the process in determining whether you want to enter or not a trade? I love this question.
Well, I mean, as traders, we always look for our setups. And when you start to see your setups as it pertains to a certain train set of patterns in your trade, or when you start to look at opportunity, now, I don't know whether or not you're a short-term day trader or a swing trader or a long-term trader. But either way, you're going to look for your setup. I mean, that's really where it's going to come down to. You're going to look for your setup. You're also going to look at, like, what is the market telling me? What is the story that it's telling me? Before I enter any trade, that's the first question that I always ask myself. What is the market telling me on this specific company? Is the market telling me right now that essentially that, okay, if I'm looking at, let's say, on a day-based chart, and if I see that price action is consistently moving well above, and essentially we've come down, but at the same token, we're respecting the laws of the higher highs and lower lows, then that's giving me opportunity as it pertains to promise. But yeah, that's for me.
So it sounds like you're a trend following trader. So in that essence, are you a breakout trader, or are you the wait for the pullback or the drawback?
I'm actually both. Actually, I'm actually both of those, because like on some, like for example, 9 times out of 10, I notice that Nvidia will have a great quarter, but at the same token, the company is going to probably sell. The stock is going to probably sell off during its earnings. So I'm not going to enter into a chat like before its earnings. I'm probably going to wait till after its earnings to see what happens and see if the dust settles. See when the dust settles, and then I come back and I'm a buyer into a company like, let's say, Nvidia. I normally don't, like, funny fact, I don't actually trade earnings. I learned that lesson probably like 2007, my junior year.
Right.
So because I always believe it's a 50-50 shot of what it can be. But I look at what the price action is before, and then I also look at, like, okay, hey, well, what is it that we're seeing post? And again, like, this year has been kind of like a misnomer for Nvidia because of the fact of multiple reasons. Like the one in May or June that you can see there, if you can zoom in on the chart, that's Nvidia telling you that, okay, hey, what was expected as it pertains to their revenue, nobody expected that coming.
Right.
Where they were supposed to only report 5 billion, and then they came out with 11. Like,
but then
if a company told me that they were,
then you had two preceding earnings where they reinforced their forecast, but then the market, I think, had over anticipation, right, or greater expectation.
Correct. There was a lot of anticipation going into the stock. So again, it's like, for me, it's like I look at it in the sense of, it just depends upon what is it that you trade. And like I said, it's like you're looking for your setup. So for me, of course, the May/June arena is probably going to be like the misnomer. But if you look at it across over a period of time, like, they still report solid earnings, but after their earnings, the stock typically falls back. So,
but if you look
notice
at
that setup,
in terms, if you use earnings as a trend for, right, it seems like there's more times it goes up after earnings than it goes down after earnings, right?
Right. So like I said, I wait for the drop, and then ultimately it's like, okay, hey, I wait for the dust to settle, and then, okay, this is the time in which that I'm a buyer, I'm a trader.
How about one more question? Any thoughts on quantum computing?
Oh man, quantum compute. Honestly, okay. So here's the thing on quantum: too early in the game or coming faster than we think. It's definitely coming faster than we think. There's already quantum chips in mobile devices. Let that sink in for a second. Like, in Google Pixel's phone, they use the same chip, their same quantum chip tech that they use in their cloud services. So that's very interesting. but as it pertains to like it asks the question. Most of your quantum computing, they're normally using it for like research-based purposes, to solve those types of high-level systemic problems. But I think 2024 is probably the year where we'll probably start to see a little bit more of those quantum computing companies come into the mainstream, where they won't just be research, but they'll probably be used more so on mainstream, not consumer markets, but more so enterprise. So look forward on enterprise conversations, more so. But I think that honestly, it's like we're probably like it's something that it's a venture capitalist's dream to see quantum computing come out and just like be like the thing. But honestly, I think that we're probably like a solid 2 to 3 years out before we fully see it in the wild of mainstream, in my opinion. Yeah.
Well, Mark, listen, I appreciate your time. I hope folks enjoyed and got something. And I certainly learned something. And I got to just remember, folks, that our discussion here is we're just kind of talking back and forth between traders. We're not making any recommendations. We're not financial advisors. Do your own homework. Do your own diligence. Make sure you understand risk. Have a trade plan. Trade your plan, and stick to your process. Would you agree with that, Mark?
I agree with that 100%.
So, where can one find you, and where are you on, let's say, social media?
You can find me across pretty much all social medias at I am Mark Monroe. That's how I can be found. You can find me on X, formerly, I guess, known as Twitter. You can find me on Instagram. You can also find me, well, you probably won't find me on TikTok because that's not really my thing yet. But you can also find me on LinkedIn by just Mark Monroe. And then on top of that, you can find me on the platform called the Come Up Series, as well as every now and then you'll catch me here on Barchart. So
yeah, if you haven't seen any Mark's videos on the Come Up Series, they're really, really good. Do you have one coming up soon? Or I know what's your regular schedule?
I do. So my regular schedule is like I'm getting to that because we're at the end of the year, and normally what I do is I do a deep dive into information and data. So tonight is like that first step where it's like I normally call it the Matrix season. And Matrix season is like where it's like I get to share my research, get to share what is it that I'm thinking and everything else. So kind of like what we started tonight is the beginning of that. And over the next set of weeks, which is my final set of weeks for doing live shows on the Come Up Series, I'll be discussing more of that. But as it pertains to recorded content, I'll start doing a little bit more of that starting in 2024, where I get to talk about a multitude of different topics, things in which that, really hit home to me and things that are happening more so in the now. And I can go a little bit deeper in depth on those subjects.
All right, buddy. I appreciate your time, and thanks so much for being part of our educational series. And again, I'm look forward to having you back on at some time. Will you come back in the future?
Of course. All you have to do is just flash the signal in the sky, and I'll arrive.
All right, Mr. Anderson.
Well, thank you for having me.
All right, folks, until next time, be safe out there. Make sure you know how to manage your risk and the good of all trading.